So the AI revolution, it's everywhere, right? Stocks are just soaring, and every big company out there is promising this incredible, transformed future. But what if? What if the financial ground this whole boom is built on is a lot shakier than it looks? Let's dig in.
All right, so you've probably heard the name Michael Burry, right? The guy from the movie The Big Short. Yeah, the one investor who saw the housing market collapse coming when basically no one else did. Well, he's back, and he's making another huge bet against the market. And this time, his target is the AI boom. He's been putting out these detailed letters, basically arguing that this whole AI revolution might be built on a house of cards. Okay, let's get into it.
So, at the very heart of Burry's entire thesis is one kind of wild question. Is this whole AI boom, with the crazy stock prices and the promises of a new world, is it all just being propped up by a simple accounting trick? I know, it sounds almost too simple to be true, but that is exactly what he's claiming. So, what is this secret trick he's talking about? It's not some super complex, crazy financial derivative. Nope. It's actually buried deep inside the financial statements, in a line item that sounds incredibly boring, but according to Burry, it's the key that unlocks this entire mystery. It's all about a concept called depreciation useful life. Now, in plain English, when a company buys something really expensive, like a server or a whole building, they don't just count that entire cost in 1 year. Of course not. They spread that cost out over what they call the useful life of that asset. Let's break this down with a super simple example. Imagine your company buys a $1,000 phone, okay? If they say its useful life is 2 years, they expense $500 a year. Simple. But what if they decide to extend that useful life to 4 years? Suddenly, the annual expense drops to just $250. See what happened there? Your yearly profit looks a lot higher, even though the phone still cost $1,000. You're just kicking the cost can down the road. And this is precisely what Burry is saying big tech is doing with billions and billions of dollars worth of those critical AI chips, the GPUs. For a long time, they used to depreciate them over, say, 3 to 5 years. But recently, they've all started extending that useful life to 6 years, sometimes even more. Now, to be fair, these companies would argue that this just reflects how much better and longer lasting their new stuff is. But Burry's whole point is this. Whatever the reason, this one accounting change makes their profits right now look much, much bigger than they might really be. Okay, but here's where the story gets really juicy. This little accounting decision, well, it creates a massive, glaring contradiction with what's actually happening out there in the real world of technology. And this slide just lays it out perfectly. On one side, you have the accountants at these huge tech companies saying, hey, these chips we're buying will be useful for over 6 years. But on the other side, you've got NVIDIA, the company that actually makes the chips, announcing they're moving to a 1-year product cycle. So how can something possibly have a 6-year useful life if the company that makes it is basically trying to make it obsolete every single year? It doesn't add up. And Burry doesn't just point his finger at the contradiction, he brings the receipts. And the most damning evidence? It comes straight from the mouths of the biggest names in the entire industry. Here's Microsoft CEO Satya Nadella basically admitting on a podcast that the tech is changing so fast he actively tries to avoid getting locked in with too much hardware from one generation. To Burry, this is a confession. It's a clear admission that they know this stuff gets old fast, which totally contradicts their own accounting. So what's the actual real-world impact of all this financial gymnastics? Well, Burry ran the numbers, and he calculated that if you adjust the useful life of these GPUs back down to a more realistic 2.5 to 3.5 years, the profits these tech giants are reporting could be overstated by a staggering 13 to 48%. That is a massive number. And let's look at a concrete example so this really hits home. Alphabet, Google's parent company, Burry points out that their decision to change this one accounting policy back in 2023, it artificially inflated their pre-tax profit by $3.9 billion in a single year. That's not a rounding error. That is a huge impact from one tiny change in an accounting spreadsheet. So what Burry is arguing here is that all of this points to a massive, misunderstood shift in what the tech industry even is anymore. It's a completely new reality that he thinks Wall Street has just totally failed to see. For years, right, we all thought of big tech as this amazing, high-margin software business. You write the code once, you sell 1 million copies, and it's almost pure profit. But Burry says that's over.
He thinks AI has fundamentally changed them into a capital-intensive business, something more like a car company that has to constantly build new, incredibly expensive factories just to stay in the game. And the profit margins in that world, they're just not the same.
And here's the kicker. The problem gets even bigger. It's not just about the chips. Every new generation of GPU needs a whole new data center design. With way more power, more advanced cooling, it's a huge expense. And on top of that, these companies have billions of dollars tied up in data centers that are listed as construction in progress. You know what that means? Those assets haven't even started to depreciate yet. It's like a massive wave of future costs, a ticking time bomb, just waiting to hit the balance sheet.
So it really all comes down to this, doesn't it? The market and pretty much every investor out there sees a world-changing AI revolution. But Michael Burry? He looks at the exact same companies and sees a massive bubble, one that's being inflated by a simple accounting choice. A choice to push today's enormous costs into a very uncertain future. The only question left is, who's right?